You have been warning for some time about secular stagnation. People have been talking about the possible Japanification, they call it, of the United States, of Europe. We have a crisis at the moment. Does this drive us faster toward that result, or is it just entirely a separate phenomenon?
No, we're essentially there. We are essentially when, interest rates reached 30 basis points earlier this week on 10-year instruments. The index bond market was telling us that for 30 years, the real interest rate was going to be negative. The bond markets were telling us that markets did not expect inflation on the Fed's preferred measure to get as high as 1% in the next generation. That means we're essentially at the Japanese place. That's a place where that's very hard to get out of, as the Japanese experience suggests, as increasingly the European experience suggests. So we're going to need bolder and more experimental approaches, and critically, we're going to need much more aggressive fiscal policy, and everything that happens in the health area is just going to make it worse. We're not condemned to decades of Japanification, but make no mistake, when the 30-year interest rate in your country is 0.3%, and the index bond that pays inflation in general is way below zero, closer to -1% than to zero, you have the phenomenon known as liquidity trap, known as secular stagnation, in which market signals are telling you that you don't have enough demand. And we're coming into a period where we're going to have absenteeism on a scale we've never seen, and already we are having those massive shortages of demand.